All right, there we go. So again, tonight, like I said, we'll review what we did last week as a whole, just real quick. I'll touch on everything a few things we went over last week, and then we'll just hop right into it. So again, last week we set up the fractals on your charts, where we set up your charts. We went over a little bit of market structure and things like that, but a lot of last week was basically, surrounded of psychology, as far as getting your mindset, to shift in a different direction, and shift of how to get money to work for you and not really, work for money. That's the goal here, basically, guys, to retire in 365 days or less. I'm trying to make it less for you all. Um, so what we're going to pick up tonight is we're going to start with Elliott Wave, all right, as I mentioned earlier. Now, Elliott Wave tells you the market cycle, and it gives you the mass psychology behind the cycle and things like that. Not only that, there's a few different guidelines to the Elliott Wave, which will help you identify different parts of it, and things like that. So I don't know if you all have ever heard me say cycles within cycles. Hi, but basically, when I say cycles within cycles, or whenever I refer to the word cycle, I'm referring to Elliott Wave. All right, let me pull this up for you. What, huh? All right, let's move this down. All right, so Elliott Wave, guys, here's the basics of it. Okay, so tonight, like I said, we're going to go over the basic wave patterns. I'm going to give you some wave characteristics of each of the waves. You're going to learn the guidelines for application, meaning you're going to learn the guidelines for how to apply it to the chart. You're going to learn the 3 essential rules of Elliott Wave, okay? And then I'm going to teach you how to identify and label some of the waves. But first off, let's get, what is Elliott Wave? Elliott Wave Principle is based on Ralph Nelson's Elliott conviction that social or crowd behavior tends to trend or reverse in identifiable patterns or cycles, all right? So that right there is going to, once you all learn Elliott Wave, it's going to help you all understand the crowd behavior of a trend. It's going to help you all understand where the market is potentially going to reverse better. And it's going to help you identify the market psychology and their patterns or cycles. So what happened is Ralph Nelson, he identified a number of patterns of movement or waves that reoccurred or in combination with larger and or smaller versions of the same patterns. Basically what that says is cycles within cycles. Those who are well versed in the intricacies of these patterns can gauge where the market's recent movements fits into them, and then predict where the market will move to complete the cycle. Okay, Elliott Wave runs on every time frame. So that means from the 1 minute all the way to the yearly, or all the way to the monthly. Again, Elliott Wave is cycles within cycles. And I'll show you the cycles within cycles on the chart, all right? We focus mainly on the daily, the 4-hour, and the 1-hour time frames when we're looking to identify Elliott Wave at the beginning of a swing low or swing high, all right? Knowing the different characteristics of the individual waves will help you identify which wave market is currently trading within. So again, I want to stress you all, cycles within cycles, all right? And there's 3 essential rules for applying the Elliott Wave theorem, and there's a few various guidelines that help apply and identify the different components. Okay, so here's what a complete wave looks like, all right? A single cycle of Elliott Wave consists of 8 waves, and that's broken down into 5 impulse waves, followed by 3 corrective waves. Okay. So you've got wave 1, wave 2, wave 3, wave 4, wave 5. Okay. Those are your impulse waves, followed by 3 corrective waves. Wave A, wave B, and wave C. 1, 2, 3. The 5 plus the 3 make up one cycle in Elliott Wave. So when I'm referring to, depending on where the cycle is, quote unquote cycle, this is what I'm referring to basically. All right. These waves are labeled basically using letters and numbers. Just notice on this picture that the impulse waves are labeled numbers. The corrective waves or the retracement is labeled in letters. Okay. Each of these waves, though, wave 1, 2, 3, 4, 5, and wave A, B, C, they all have their own individual characteristics that help identify them. So basically, if you understand the characteristics of, let's say, wave 5, then you're going to understand that the market is going to, enter a retracement. So you'll be looking in a position to sell up here. All right. So let's see. All right. So there's 3 rules basically when you're applying Elliott Wave. I do want to, just point out that these quote unquote rules, they're merely guidelines that were proven to have a high success rate when followed, even though it's not 100%. Okay. So basically, hold on real quick. All right. Sorry about that, guys. All right. So, as I was saying, these rules, like I said, they're just merely guidelines that were proven to have a high success rate, even though they're not 100%. So, sometimes basically what that means is even though if you follow everything correctly to 100% to a T, you still may occur with a loss and things like that. And that's just with trading, period. You know what I mean? Things can be perfectly aligned and you can still lose a trade. All right. So the 3 rules, guys. The first major one is wave 4 cannot enter the price territory of wave 1. If it does, the market's latest move must be a part of a larger motive wave, which could be progressing higher or lower. Okay. I want to expand on this one. When it says it cannot enter the price territory of wave 1, it can, but when it does, you don't want to see the candles closing within it. And I'll show you this on the chart. Guideline 2, wave 2 can't retrace more than 100% of wave 1. According to the Market Technicians Association, if it does, then wave 2 might not be a corrective wave as originally thought and could actually be moving in the direction of a motive wave to a larger degree. When it says moving in the direction of a motive wave to a larger degree, that's again referring to cycles within cycles. Wave 3, which often represents the strongest part of the market cycle, can't be the shortest by price compared to wave 1 or wave 5. So what that means is wait from the high and low between the low from point 1 to the high in wave 1. Let's say that moves 50 pips. Okay. Wave 3 has to move at least 50 pips or greater. And then wave 5 would have to move less than 50 pips. Okay, so basically what I'm trying to say is the price difference between on the waves has to be, well, wave 3 is typically the strongest. And I'll show you all this on the chart. Let's see. All right. So here's those guidelines in a picture formation, okay? Wave 2 never retraces more than 100% of wave 1. Here's wave 2, right here in blue. Wave 2 can retrace all the way down here to the beginning of the swing point low of wave 1. It can even pin below that, guys, okay? But as long as you see price pulling back within this same structure point that's at the swing low of wave 1, you're good for that long position. Like you can even see a nice railroad pattern form right here. So if you see a nice heavy bar or margin boot bar below this price, let this next candle close because it could pin down a little bit, but if it closes almost equal or similar, same size as that first bearish bar, that's a railroad pattern reversal basically, okay? So that's one of the guidelines. Guideline 2, wave 3 cannot be the shortest wave. So again, from this swing low to this swing high, this wave is typically where most of the profit is made. All right. Not only that, that move is typically the longest and the strongest move. This wave would be shorter than this wave. This wave would be shorter than this wave. This wave can be longer than this wave, but as long as it's shorter than this wave, you know you're in a wave, wave 3 basically. That's what that guideline is basically saying. Guideline 4 says wave 4 does not have candles that close in the price territory of wave 1. So wave 1's price territory is from this swing low to this swing high. That's why this pink line is drawn over. That's giving you that high point or that structure point. Wave 4 is a retracement. So what we're looking at, guys, is for wave 2 to break through this high. Wave 4 comes down and tests that high point and then shoots back up for the wave 5. If wave 4 gets below this high point, then it's going to continue more. It's going to continue down, and that's when the higher degree of a cycle might be in play. Does anybody have any questions just yet? All right, we'll keep going. All right. So here's some characteristics of the different waves, basically. So every wave, impulse, and corrective have their own individual characteristics that help identify them. When applied together and with the different guidelines, which we'll cover in depth later, identifying waves can become a little bit easier. One of the keys to interpreting wave counts is to determine what degree the wave in question represents. So with the characteristics of wave 1, wave 1 is an impulse or a motive wave or a trending wave, okay? Wave 1 is either at the top of a trend for the sell or it's at the bottom of a trend for the buy. Wave 1 is also very hard to identify as no trend is evident. Basically what happens is wave 1 typically drifts. Looks like it's drifting a little bit. You know what I mean? It's less emotional as the prior trend is still in control. Wave 2 characteristics. Again, wave 2 is a retracement or a corrective wave. Wave 2 cannot retrace more than 100% of wave 1, even though it can extend the low created by wave 1. Okay. This is when the guideline of alternation between wave 2 and wave 4 comes into play, and we'll get more on that later. Traders usually continue to sell, so movements are usually steep and sharp. Wave 2 is the second half of a W or a double bottom, and it typically corrects most of wave 1. Wave 3 is another impulse wave or another strong trend wave. It usually has the largest change from swing low to swing high in terms of price. Again, in terms of price. Its powerful moves are made in this wave, and like I said, this is where most of the profit is made. This wave is emotional and most often the longest, steepest, and strongest of the waves and has the greatest profit potential. Wave 4 again is a corrective wave. And then once you learn the difference between wave 2 and wave 4, you can apply the guideline of alternation. Early traders take profit and others enter in longs and witness whipsaws in the markets. And then wave 4 typically trades sideways or is a consolidation. Characteristics of wave 5. Wave 5 is the final advance towards either the high or the low. Okay. What we're looking for in wave 5 is a lot of pullbacks or a lot of felling of price at the high or low at a support or resistance. We're also going to look for a change in momentum. If we were using the RSI or the MACD, or some kind of oscillator, you can look for divergence, as price will set a higher high while the RSI or the MACD will set a lower high than the previous high. And I'll show you this on the charts as well. After this wave, market will enter into an ABC corrective phase, which will retrace anywhere between, I would say, 50% all the way to the 86% or 88% of the whole one wave 1 through 5. And I'll show you on the chart as well. All right, so the corrective characteristics. So this would be the waves lettered instead of number. What are corrective waves? They are correction to the market that happens after a trend or impulse wave. Correction takes place after impulse waves 1, 3, and 5. So waves 2 and 4 are corrective waves, and then after wave 5, it enters a bigger correction. The guideline of alternation can also be applied in corrective waves, and they're labeled ABC, but can be an extended correction, adding the letters D, E, F, G. The D, E, F, G are more for like your flats, your pennants, your wedges, and things like that, or your zigzags. All right. Corrective wave A. The characteristics of corrective wave A, you have the market will still be in an overall bullish or bearish market, meaning this is only a correction to the market. We buy the dips on bull markets and look to sell on uprisings in a bearish market. Okay. If wave A travels in 5 cycles, again, this is cycles within cycles, it will be a deep zigzag. If wave A travels in 3 waves, it will be a flat or triangle structure. Wave A sets the tone for wave B in the corrective phase. And then that's between wave A and B, there's another guideline of alternation that we cover. Real quick. Somebody raised their hand. I don't know who it was. All right, corrective wave B. Corrective wave B is a trap wave of the corrective phase. This is when traders become euphoric and anxious about continuing the prior trend, all right? Which meaning is the continuing of wave 5 or the impulse move. This is actually a good place for a counter trend trade coming with the wave C, because wave C is usually the extended wave. All right. Corrective wave C is usually the killer wave. It wipes out a lot of positions from the impulse trend because it's a strong move in the opposite direction. It's usually going to strongly move until it hits some kind of support. It's often an extended wave, but once it's over, it's time to get back into the market and follow the impulse moves again. All right. Let's see. Do I want to get into this right now? Yeah. All right. So within the Elliott Wave cycle, on the retracements are measured by Fibonacci ratio of 0.618 was made famous by a 13th century mathematician named Leonardo Fibonacci of Pisa. Basically, it's the sum of two based on a number sequence. Adjacent numbers forms. Wait, hold on. The sum of two based on a number sequence. Adjacent number forms the next higher number. So 1 plus basically 0 plus 1 is 1. 1 plus 1 is 2. 1 plus 2 is 3. 2 plus 3 is 5. 3 plus 5 is 8, and so on. That's Fibonacci basically, and a few other mathematical equations to it. But 0.618 is often referred to as the golden or divine ratio because it has been found throughout nature, such as the breeding pattern of rabbits, our own DNA, how petals on a flower are arranged, proportions of the human body, even in the galaxy spiral, and so on. The 5 waves of a motive wave have a Fibonacci relationship with the 8 waves of a complete cycle. So basically, waves 1 through 5, the impulse waves, we measure the retracement waves, A, B, C, with Fibonacci. Okay. All right. So how do you apply Elliott Wave and what to look for? Remember, a guideline is not a hard and fast rule that can't be broken. It is a tendency and something that happens so often that it can almost qualify as a rule, except for times it doesn't work as expected. And this goes back to earlier. Rules, it doesn't work 100% of the time. The guidelines are useful ways of applying Elliott wave analysis that have shown their validity over time. But again, as they are not rules, they may not work out every time. All right. So here's the guideline of equality. This refers to basically market geometry. It refers to price. Okay. The guideline of equality says that 2 of the motive subwaves in a 5-wave sequence will tend toward equality and is generally true of the non-extended waves. So going back previous in the lesson, we said wave 2 was typically the strongest, right? The steepest and the biggest. So the guideline of equality says if whichever wave is the strongest and biggest, which typically is this one, then wave 1 and wave 5 will trend towards equality or market geometry. The market likes to stay in symmetry. Not only that, this means that when wave 3 of an impulse wave is the extended wave, wave 5 will approximately equal wave 1 in price. This is useful for potentially projecting the end of a wave 5 in an impulse if you recognize wave 3 as an extended wave. So what that means is if you took a trend line tool and went from high to low or low to high, copied and pasted, let's say you saw this completing on this retracement, and then this retracement was about to complete, right? Copy and paste that same trend line. This low goes to this low, and then the top of this is going to be your projection for your take profit. And that's the guideline of equality, basically. The guideline of alternation, this is within the impulse waves. This is for waves 2 and 4. The guideline of alternation within an impulse says that the forms of wave 2 and 4 will alternate. If wave 2 is a sharp style correction, or if wave 2 is a deep retracement into wave 1, wave 4 will be more of a flat or a sideways style correction. But if wave 2 is a flat style correction or the sideways consolidation, then wave 4 is going to be the sharp or the deep retracement. All right. This is useful for anticipating the end of a wave 4 correction within a suspected impulse. So this is wave 2. This is wave 4. If wave 2 comes all the way down here, wave 4 is going to be flat. If wave 2 is flat, wave 4 is going to come all the way down here. Hold on. All right. Now this is the guideline of alternation between a corrective wave. The guideline of alteration within a correction says that the forms of wave A and wave B will alternate within the three-wave correction. So if wave A, again, is a flat type correction, then wave B might be the zigzag type of correction, and vice versa. It also states that if the correction begins with the more simple wave for wave A, expect the following waves B and C to be more complex. Okay. So the guideline of depth of correction waves. This goes back to understanding a little bit of Fibonacci, which we'll get into on the next class, and then a little bit of a different guideline that we'll cover here in a second. When the market goes into a correction, it will often correct to the territory of the previous wave four of a lesser degree. This does not necessarily mean that it will reach down to the bottom of the previous wave four, but rather that we should expect it to reach the span of previous wave four of a lesser degree. It is often a good place to find market support or resistance, depending on the trend, before the trend moves on. So here we've got wave five, right? The guideline of depth corrective wave refers to this whole ABC move, okay? Here's wave four. Here's swing high, swing low, which creates the wave four. So on this correction, we should see it come to basically no lower than the low from wave four before it pops up again. If it does, then we know we might be looking at a move to a larger cycle, basically. All right. Okay. So what we've done in this lesson basically was I've identified your impulse wave and corrective waves, gave characteristics and property of each wave, used the various guidelines to identify a wave, and we get some more lessons on this later on in market structure, but we'll go to the charts now. Let's see. Before we do that, do we have any questions yet? Questions? Nope. All right, we'll keep on trucking. Let's see. All right. So when we're looking for Elliott Wave, I'm going to show you some different guidelines. Now, as new folks just now learning this method or just now learning about Elliott Wave and things like that, don't expect to master it overnight or don't expect to see it on the charts as clear as I do just yet. All right. But I'm going to mark it up for you so that way you guys see. Okay. So from this low to this high is what we're looking at. It doesn't look like much just yet, but here's the Elliott Wave cycle. Do it right there. I'm gonna find a better example after I mark this one up. Ooh. Let's see. All right. All right, so that might look a little cluttered to you right now, but here's what I've done. Let me change this to a different color. No, change this to a different color. Okay, so here's what we've got, guys. Impulse leg 1. You see this consolidation right here, this sideways? That's wave 2, marked in the pink. Here's from high to low, back to the high. That's wave A. From this low to this high is wave A. I mean, this is wave A, I'm sorry. From this high to this low is wave A. From this low to this high is wave B. From this high to this low is wave C. Okay? From this low back to this high, that's another impulse leg. That's another impulse move. Now, in the example, we said wave 2 was typically, wave 3 was typically the strongest movement or the steepest or the most powerful. Here on the chart, this is the perfect example that shows you that's not necessarily 100% true all the time, because if you notice, after this retracement, look at this move right here. This wave 5 move is the extended wave. So if you did the guideline of equality, here's the low. What I did was I got the trend line tool, went from low to high to measure that price movement, right? Just looky there. Basically, that's a 1-to-1 move ratio, and that's market geometry and things like that. So again, this is all something that the more you study it, and I've got some more videos, I've got some more books to give you all over these topics and things like that. But again, this is just the introduction of it. We go in depth over everything in further lessons. So again, wave 5, as we notice, is the extended wave. What I mean by extended wave is the cycle within a cycle. If you notice, there's another 5-wave cycle. 1, 2, 3, 4, 5. So wave 1, wave 2 is steep. Wave 3 was the biggest move in price. Wave 4, sideways, right? Wave 5 was small before a nice retracement, which we're in right now. Okay. Does that help you all a little bit? Any questions so far? I'm gonna keep asking you. I know there's questions out there. Let's see if I can find a better example. Hold on, guys. I'm trying to look. Let's see. Here goes one. All right, so from this low, we can do 1, 2, 3, 4, 5. All right, so what I did was I identified, to me, what's easier to identify these would be looking for the retracements, looking at the retracements, because like I said, that's the easiest guideline to memorize, because you understand that if one of these retracements is flat, the other retracement is going to be a deep one or a diagonal one like this. If this one's the diagonal one, then this one's going to be the sideways one. So let me see. I can't even mark that up, but and that's the guideline of alternation. Again, so That's what helps me identify the Elliott Wave patterns most. So once you know that, you're in a retracement, or understand that this is just a retracement, right? You understand that you're going to be, on that buy. Not only that, guess what, guys? You've got the fractals showing you when to enter, where to enter. And then later down the road, we add in market structure. And not only that, in the lesson we said there's a Fibonacci relationship with Elliott Wave, right? And that's on these retracements. Fibonacci will measure the retracements, and our entries are typically in between the 618 and the 886. This 382 is a nice strong bounce up as well, but that's more for experienced traders and things like that. We like to see a little deeper retracement. Let's see. So what we're going to do now is set up your all's Fibonacci tool. So what we need you to do, or what you want to do when you're setting up your Fibonacci tool to add the custom ratios that we use, of course, just draw Fibonacci on your chart. Double click on it, right click on it, go to format, and I fed her when I got home. That was about, yeah. Okay. And then so sorry about that. Go to format or go to properties of the Fibonacci tool, and the ratios we're going to be adding is the 0.786 and the 0.886. All right. These are two entries, or two levels where we like to set pending orders at. And the reason that is because more times than not, if you get the right low, or if you get the right structure point properly, let me show you some things. Typically, the in between the 618 and the 886 is our entry. So let's say from this fractal on this impulse down all the way to this low, this retracement came up into the 786, 886. So from that high to the low, here's the 618, here's the 786. So like I said, the 618 is our threshold for our entries. If price comes down and retraces up into this some more, we've got some pending set up here. Our stop loss is all the way up here at the 1.1, which is above that high. So which means if price does retrace all the way up here and get above it, then you already know, it's going to continue to go up. You can begin to look for enter to buy, basically. But like I said, this is in more lessons. Tomorrow we'll get into the more deep detail of the Fibonacci and things like that. But for tonight, I wanted to get you all introduced to the Elliott Wave. I've got a video that's about 34 minutes on Elliott Wave that I recommend, or that I'm going to need you guys to watch as homework. And then I've got a book on Elliott Wave. It's not required for you all to read it, but I'm going to put it out there for you guys, further your own knowledge up on it and things like that. It's a very good book. But other than that, guys, this is what I really wanted to cover tonight. Well, like I said, Elliott Wave, and tie some of the stuff in from last week as far as like the fractals, and then introduce Fibonacci so that way we can cover that on Wednesday. And then Thursday we wrap it all together with last week and this week, and we're good to go. But tonight wasn't pretty much, I don't know if it was too much information, but like I said, it was just like a basic beginning. Y'all have any questions yet? You're free to speak. What's going on, guys?
Is that 20? Is that the 20 EMA or simple? Moving average on that?
21 EMA.
Sorry for my 3-year-old. Let me mute this back. 21 EMA.
Yeah. Oh, no, you're fine. And you do the levels again. On the Fibonacci levels, yeah, I can do the levels. So you're going to add 0.786 and 886. So just use your Fibonacci tool. Just draw one on your chart, doesn't matter where. Click on it, right click on it, go to Format or Properties, depending if you're using the MetaTrader or TradingView. This is on TradingView. Hit Format. And then like you're gonna have numbers in all of these, which is fine. You can just simply delete one of them or delete 2 spots. I would recommend like one of these higher numbers or something like that. And then type in 0.786 and then 0.886. After that, just hit OK. Does that help you out? Uh-oh. Where'd you go? I'm not even sharing my screen. Hold on, I'm sorry. I thought I was sharing my screen still. All right. So again, here we go, Sheena. Go to Fibonacci tool. If you have to, click this drop down arrow and then come to Fib retracement. Click on it. Just Fib on the screen. Right click on it. Either Format or Properties, depending on if you're using MetaTrader or TradingView. All right. So on these boxes, now that you can see them, you can delete any of these and then just type in 0.886 right here, and then type in 0.786. When you type them in though, just make sure this checkbox again has a check mark in it, so that way it shows up on your tool like this. Let's see, hold on, I need to get you all this stuff real quick. So the first link is the short like PDF version to the basics of Elliott Wave that you all can read over. Because like I said, it's a lot of information that I covered. And then I'm going to send you a video or link to a video. It will also go over the basics, but it gives you a different view of the basics of it. Okay, it's like 35 minutes long. All right, there you go. Boom. Let's see, let me copy and paste this. I'll also paste this in the chat, so that way people have it. All right, guys, what's up? I know y'all got questions. Let's see. You can unmute yourself if you need to ask a question, or you can just type in the chat box. But I need some kind of interaction. Let's go. What's up, my man?
Yeah, I have a question. All right, so can you hear me?
Yeah, I can hear you.
All right, so is the first wave identified as a upward trend all the time, or
No,
how does that
that's a
work?
good question. No, it just let's see. Let me share my
And
screen.
every example that you showed is the starting root of an upward trend.
All right, so let me show you all. Let me go back to that one actually. Mhm. All right, so on wave one, all right, so this is wave one. Wave one typically isn't going to be this pronounced. It's usually kind of choppy, but it still drifts up because it's wave one. The reason why it drifts up and it's choppy is because again, this trend, this downtrend is ending. All right, this downtrend right here is ending. So it gets people psychologically. The choppiness gets people to to sell. All right, because they want to continue this downtrend right here. Notice what happens when it reaches that first resistance point. It starts to pin and leave telltale marks of going short. But this is when you have to understand market structure and then know what the market is doing as a whole, as far as a cycle within the cycle. What I'm showing you right now is on the 15-minute chart. We could have been on the hour chart of the 4 hour and then marked up, an even larger cycle of as far as using Elliott Wave. But for this purpose tonight, I just did it on the 15-minute chart. But again, wave one is typically choppy, typically drifts in the opposite direction of that predominant trend that just happened. And then wave two typically is the deeper one. Let's see. Does that help you out?
Yeah, kind of.
Okay, so, but no, wave one, it just depends on the trend. Wave one is always the beginning, though. Wave one is always the beginning of either an uptrend or a downtrend, depending on which way the market's going. Let's see. Sheena asked, how many waves are there? In one cycle, it's 8 waves. Let me go back to the 15-minute. Again, you've got your impulse waves numbered 1 through 5, and then you have your retracements lettered A through C, A, B, C. Then you got 1, 2, 3, 4, 5. Then you have A, B, C that should be forming. But when this pops, so since this is a complete cycle right here, on this retracement, you've got wave A. All this right here, you could consider as being wave B, because what's happening is this point down here, or this low point down here, should be tested. And this is when some of the guidelines don't apply, as far as the depth guideline. On the smaller level, it applies because you've got wave A, B, and then C. Notice though, let me delete this one, and this one. So you've got A, B, C. Remember the depth guideline? Here's wave 4 right here. A, B, C is basically, it's completing within that depth of the wave 4 right here. All these lows. But in the bigger scheme of things, we've still got some of this down here to be tested. But this is all going to come in, further lessons down the road. Like right now, I just need you all to get to learning how to identify them as far as just applying the guideline of alternation, which means if wave 2 is flat, wave 4 is going to be a steep. If wave 4 is flat, wave 2 will be the steep. More times than not, wave 2 is the steep one though. And like I said, to look for that, you want to find your impulse leg, or you want to find, basically an impulse leg, like a move up like this, and then see how this retracement, and then you got another move up. So just look back a little bit, and you'll see, oh, it's just a trending up, something like that. You know what I mean? Or you can do low here, low here, higher, low, higher high, higher low, higher high, low, higher, lower high, and then now it's final support. But again, this all comes with time and things like that. So, 5 impulse waves, 3 corrective equals 8 total. All right, guys. Any other questions? I don't know. Any questions, guys? Hello. Oh, what's up, Tiller?
I don't really have any questions yet. Just taking it all in, but in theory, it all makes sense.
Yeah, it's like I said, it just helps you all view the market differently and see things differently that you need to pay attention to. Because once we actually get into like the entry method and all that good stuff that's coming up, like I'll tie all this stuff in together. But I need you all to understand each individual piece before it makes sense as a whole. You know what I mean? So,
No, that makes sense. And the more tools, the better.
yeah, of course. Let's see. Next class we'll tie in, finish up a little bit of Elliott Wave. We'll just review today, and then we'll go over Fibonacci. It'll probably be a shorter class because Fibonacci isn't too much to it actually. I just show you some different things of as far as like the properties of how the retracements react once they're reached the different levels and things like that. So that way you can identify your take profit. You'll be able to set up different harmonics once you understand Fibonacci off of it and things like that. But yeah, that's next class would be Fibonacci, and then we'll spend some time marking up Elliott Wave and then showing you all how the different Fibonacci levels, react afterwards. Cool beans?
That's a bet.
All right, now y'all. If there's no questions, guys, I sent the link out for the first video in that series on Elliott Wave basics. I'll get this again rendered and uploaded. Yeah, that's a good question. Tavoris asked, does this work on all pairs, including crypto? Yes. This is just pure technical analysis, man. It's not like no special sauce, nothing like that. Yeah, crypto's scary, man, because you blow your account real quick. Promise you. Stay away, man. This new trader, stay away. No, don't. I'm not gonna say. Woo-wee.
Yeah, I saw Smith kept losing money going to the microwave.
Dang, that's a lot, bro.
Yeah, it killed me all the way. But listen, check. It was like profit though. Like I made about like I said, I forgot and went to sleep down like 150 and forgot. No stop loss, no nothing. Woke up